Welcome to the BullionMax podcast. I'm Mark Allen, along with Sean Reynolds, the customer service manager for BullionMax and the co-host of our podcast. Hi, Sean. How are you?
I'm doing well, Mark. How are you today?
Terrific. And we are joined once again by our friend Craig Hemte. Craig is the mastermind behind the TFMR report blog, and that stands for Turd Ferguson. And in all my years in broadcasting, I've never used that word turd before until I met him. Yeah, exactly.
Second time here.
Sweet.
Right.
Well, I'm glad that I can still provide a first.
Yes,
Mark. That's awesome. Yeah, that's a name I picked up. It's Zero Hedge back. Geez, I don't even know, 14 years ago. And that's that was a username I had there on Zero Hedge. You sign up and you pick a name, anonymous name, like you do at my site. I mean, everybody has their own anonymous name, on all these internet sites. And that's the one that stuck with me. So that's what the TF is in TF Metals Report. So anyways, but I've been, so that and my site's then been around for 12 years, and I everywhere else I go, everybody can call me Craig, but I still use the Turd Ferguson on my site because everybody else has their own moniker too. So it's all part of the fun we have there.
Got it. You also told me last time we talked with Sean and I talked with you that your mom is also calling you Turd Ferguson.
Yeah, she got to that point where she would call me that too. And the most fun I get sometimes is like there's an old friend of mine by the name of Alistair McLeod who works for Gold Money. And Alistair is kind of a proper Englishman. And when he gets going, he sounds a little bit like C-3PO. I don't think he'll mind if I say that. And so back in the day when he would call me that name, it was always just great to hear in that kind of proper English accent. But anyway, it's Craig everywhere else I go. So anyway,
got it.
Well, you get the James Mason Turd Ferguson.
Right. Exactly.
Absolutely. Yes.
Exactly. So anyway.
Well, let's
remember who James Mason is. I mean, talk about an old pork. Come on.
Right. No, he was that old. I can see him in my eye.
I can too.
Yes, Heaven Can Wait with Warren Beatty. You're still Joe Pendleton.
Right.
Yeah. Okay.
So let's talk about your background, Craig, in the precious metals arena, and how you got involved in it, and maybe even what you did before you got started.
Well, when I was in my impressionable youth, I have a brother-in-law, still my brother-in-law actually, but he was a commodities broker back in the middle 80s, and a brother who then was a stockbroker back in the middle 80s, back in the roaring Reagan period, and everybody's having fun. And I actually started trading soybean options with my brother-in-law when I was a junior in college in 1987. And I had proclivity for gambling anyways, but anyway, that was great fun. And soybeans had taken off that summer. The next summer, 88, was even crazier. It just stopped raining in about April. And didn't rain in the Midwest for about 60 days. And man, the beans in the teens and all that kind of stuff. And so at that point I was hooked. I was actually got my Series 7 financial, stockbroker license. Are there even stockbrokers anymore? Even call themselves that anymore? I think everybody is like a
financial planner or something much more puffed up.
It's these fancy titles for salesmen, basically.
That's it. I was going to say the same thing, Craig. That's all they are.
So anyway, I got that license back in 1990, and I just kind of spent my whole career in the securities industry, and various different career paths. Then I even before the financial crisis, I started getting kind of disillusioned with all that, and headed off kind of a not necessarily early retirement, but I wanted to go a different path, and eventually began TF Metals Report. And my interest in the metals peaked in about 2008 or 9. And I had an commodity option trading account, and I was doing other things. And I started trading gold and silver too in about 2009, coming out of, the first QE program and all that stuff. And to my eye, having been in the markets for, at that point, a couple of decades, it didn't take long too long of a period of time of trading gold and silver to go, something's weird about these two. There's something not quite right. They don't trade like everything else. And then you start learning about, the history of not only physical gold, but also the history of gold futures and everything else. And then all of a sudden, you start connecting the dots, and so here we are. And it's been interesting to watch, all of that evolve over the last dozen years. I mean, we're finally at this point where, as we record this on Thursday the 4th, we are waiting. The jury is deliberating in Chicago on the trial of the former head of the J.P. Morgan's precious metals desk.
Right.
The U.S. Department of Justice indicted him and a couple other traders under the RICO statutes, the stuff they use for mobsters. And so I don't know if there's like 16 counts. Wow. I don't know if they'll convict them on all 16. The jury's been out since last Friday. I mean, they've been deliberating all week. So I would imagine they're kind of going through count by count. I've watched enough TV. I don't know if you guys ever watched like The Lincoln Lawyer on Netflix. It's pretty good.
Yeah.
That they may return a verdict where they go, on count 1 the defendant is not guilty, and he starts to sigh relief, but on count 2 he's guilty, and on count 3 he's guilty, and count 4 not guilty, and that sort of thing. That's probably what they're doing. But this recognition now that what we recognize as the gold price is actually derived through the trading primarily of these kind of derivative futures contracts. And who controls the supply and the demand of those and that sort of thing. So the journey has been a long, strange one. I think we're finally making some progress, and physical demand is the key to this whole, the key to finding real price discovery. And that's why I'm thrilled to I only associate with a couple of different bullion dealers, and I'm thrilled to work with BullionMax because you need to own physical metal as protection against the madness. You need to own physical metal to take it out of the hands of the banks and affect their ability to control the price. And you got to work with, trusted, smart people to acquire that metal. And like I said, that's what I think of you guys. So anyway, we'll keep fighting the fight, and hopefully one day we'll get to that point of true price discovery. We're getting there.
So let's take a look at the overall economy. Just as we were, before we started the show, the three of us were talking about jobs, okay? And there's a job report coming out, I think, tomorrow. But here in Southern California, where I am, and I'll ask you guys where you are, Sean in Oklahoma and Craig, you in Kansas. There are signs everywhere. There's a digital sign as I walk into a local market, hey, need a job? Yep. We're looking for people like you. And they don't have enough people to work right now.
Yeah. Where'd they go?
Yeah.
I mean, seriously, that's what I ask my wife this every time we go to a restaurant. I mean, I was in Omaha, Nebraska, Monday night, and I met my daughter at a Cheesecake Factory restaurant. Right. We walk in and there's like a line to get in, but I look around and that maybe only half the tables are full. And it's like, well, what's the deal? Well, we don't have the staff to serve all the, and it's like, well, where the hell did these people go? They had the staff 3 years ago. Right. I mean, it's like the rapture came and none of us noticed.
And COVID didn't get all of them. Right.
I know.
Yeah.
The number wasn't that high.
Yeah. It's just the strangest thing. And so it impacts eventually, you would think, inflation. I mean, real wages, inflation adjusted wages, which is another thing we'll watch tomorrow morning with the next job report, have fallen something like 11 months in a row. So inflation is outpacing wage growth. Well, you would think at some point wages have to go up to attract, that Cheesecake Factory's got to start paying $20 an hour to get people to come in, that they can make that work so they can sell more food and have more customers. But that doesn't seem to have happened yet. It's an oddball deal.
It really is. It's very strange to me in that the inflation when I guess what I'm trying to say is that inflation in the past has been in the result of one thing, but today's inflation is due to something else, and we don't know what it is.
Yeah, and I think that's probably. I'm sorry, I didn't mean to interrupt you, Mark.
No, that's
But
go
I
ahead.
think we are in such unprecedented times. It began in 2009 that I think economists, but particularly Fed economists, don't know how to measure it. They don't know what to do with it. You think back to 2009. That initial QE program in March of 2009 was supposed to be a one-off, and Ben Bernanke sat in front of Congress and said, oh, this is a one-time deal. It's $600 billion. We'll never do it again. We're not monetizing the debt. Oh, I know we're buying treasuries, but we're not monetizing the debt. Okay, whatever. And they've been playing this game ever since. And what's interesting is each subsequent QE program that has been announced over the last 12 years has been larger. Because the size of the market keeps growing, and every time they stop, they have to run faster to catch back up. And so I don't think this is all a first time experience for them, and I don't think they even understand that when you print, you take your balance sheet from 4 trillion to 9 trillion. It's not, they didn't just simply quarantine those dollars as they did with QE, the first QE program, where they were just simply shoring up the balance sheets of all the big banks. This was actual cash that got out, and it went to people through stimulus checks and what was that, the program, you get $10,000. What was that called? Each business could get 10 grand, all that sort of stuff.
Right.
That's money that actually got out in society. And that's, the simple economic math is too many dollars chasing too few goods. And so I don't think they have the tools or the models or anything to fully appreciate. That's why it was all this transitory nonsense a year ago, because they didn't understand it. I mean, you and I, we all three understood it. We were like, well, God, you could see this coming a mile away. Sure. But in their official models, they didn't really have the tools to grasp it. And that's where I think they're probably off now too. They're sitting there trying to say, well, no, there's no recession. The three of us consider and go, well, I don't know, the economy is contracting. The PMIs are all terrible and all this other stuff. But Powell and the president and everybody else says there's no recession, because again, they lack is uncharted waters. They don't have the map to tell them that this leads to that, and they can connect the dots and and make a forecast.
Yeah, either that or they want it to be a certain period of time, and we haven't reached that time yet, so you can't call it that yet.
Yeah.
No, it looks like it, and it sounds like it, and it feels like it, but not enough time has passed. Right. So it can't be that yet. I often wonder about just all those years that we looked at GDP, and what does that have to do with the health of any given household?
Yeah, no, that's right.
I just often wondered, is using that as your measuring stick, and maybe we should have been looking at other things all along, and maybe we would know more if we had more history, if we were looking at different economic things,
or if we were just more honest with ourselves.
I
think everybody understands that the CPI is understated and has been since 1992, when they changed the formula, when Greenspan wanted to change the formula to control the cost of living adjustments of Social Security going forward. So that's understated. The Fed's core PCE thing, deflator, that's understated. Well, by understating it, when they report GDP all those quarters over the last 2 decades, that's an inflation adjusted number. So they're saying, well, it's plus 2%. Well, if inflation was actually 2% higher, it's actually plus 0% on a real GDP number. And so it's always been kind of it's like the jobs report. We're going to get a jobs report tomorrow. And it's based on 1 week of, limited surveys during the month of July. And just the rest of it is just statistical guesswork.
Right.
Well, how relevant is that to like one component of this? And everybody should watch for this and break it out. One component every month is called the birth death adjustment. And, at first glance, you might go, what's that? Is it a census thing? How many people born, how many people died? No. I mean, people are just born, and people that just died most of the times weren't working. That's not what it's about.
True. That's not your workforce typically.
Right. It's about companies that are being started, versus companies that are dying, going away.
Okay.
And so the BLS in their, looking backward model can say, well, over the last average 20 years of August or Julys, on average in July, there have been X number of businesses started and X number of businesses closed. And that results to a net gain or loss of 150,000 jobs or something. And so they, off of that average, they will start from a baseline for this July of 150,000 jobs and then apply, all this other statistical and survey work. Well, you can't say that this July had anything in common with the previous 20 Julys.
Right.
But that's where they start.
Yeah.
And so the whole thing is this gobbledygook of statistical guesswork that we're supposed to take as, the Bible truth that Moses brought down from Mount Sinai.
Yeah, Bible truth based on a swag.
Right.
And a swag being a scientific wild ass guess.
Right. So we could start with being honest, with ourselves about this stuff, but that doesn't appear to be.
I'm scratching my head, and I think the people in DC are scratching their heads and as well, because we've just never had a situation like this. It is so unique, right?
Right. And so how do you get out? How do you get out of it?
Mm-hmm.
And again, I was asked a couple times earlier this summer about, if you were Jay Powell, what would you do? And I said, well, I never would have taken the job a second time.
Right.
I mean, I'd be retiring and giving speeches for a couple $100,000 a throw, why? You got to be some kind of megalomaniac to want the job when the media treats, the Fed people as demigods anyway. They all walk on water. Anytime there's an open microphone, they jump on it, and they love the FaceTime on CNBC and all that stuff. Or they chortle and laugh about how smart they are. But why would you want the job? I mean, so inflation that you caused, really, and the politicians caused, with all this profligate spending, you got to get that under control by trying to bring those dollars back in. But by trying to bring the dollars back in, you're absolutely crushing the economy. And you're putting people out of work. We're gonna save the economy by putting people out of work and causing a recession. What? Huh?
I thought we were supposed to fix it.
Right.
Yeah.
So it's a really
it sounds like you're breaking it more when you do that.
Right. It is an impossible situation.
It makes no sense to me. Our guest is the publisher and all this other stuff. He writes, he does a podcast, Craig Hemte from the TFMR, the
TF Metals Report.
TF Metals Report. And you've been doing that since, it says there, 2010. 2010. Wow. And we really appreciate your being with us. I'm going to turn this over to Sean and ask Sean, how are people reacting when they call in to buy precious metals, especially gold and silver right now, and take physical possession of these metals?
It's funny. So many people make a point of, and I want to have them shipped to me. I don't want them somewhere else. I want them shipped to me. And I'm glad that's what you want, because that's what we do. We don't vault it. We don't hold it. It's not going to be a precious metals IRA. We've got other connections to help you with that if that's what you want. But tell you what, right now people are looking for ounces. So right now, man, I don't know if anybody can beat our 1 ounce kangaroos, silver kangaroos. Something as cool as the buffalo. We've got a fantastic price on those. I mean, it's $10 more than an eagle. Buffaloes are normally a lot more expensive than an eagle than that. So go to BullionMax and check it out. We've got some great, what I call solid ounces. And I call a solid ounce anything somebody would be happy to see on the day that you're liquidating, you're trading, you're cashing out, whatever you're doing. If you've got good ounces, then you're going to have an excellent result with the trading that you do, especially if the market keeps going up.
Sean, do you have supplies of rounds that are not, they're not, like the kangaroo and other collectible coins?
Sure. We've got rounds as well and bars. Our 10-ounce bar business has been picking up quite a bit. I think people just like the format. It's about the size of a deck of cards. Plus, you just stack them like bricks in your gun safe or wherever you happen to be keeping your metals. And it not only looks good, it feels good, because you feel like you're getting somewhere as you're starting to amass some quantity. So yeah, 10-ounce bars are doing really well right now. We've got great prices on those. Coins and rounds, and for fractional gold, bars. our premiums are way low on fractional gold bars. So if, again, ounces is your goal and you don't specifically have to have coins, then don't get coins if you don't have to have coins. Do the bars. The 10 gram and the 5 gram are really, really competitively priced now.
Craig, is this a good time to just get into buying gold and silver?
Well, I'm going to sound like a stock answer, but yeah. Anytime is. If I might share my own personal experience,
Sure.
the life-changing really event was my first 1 ounce gold coin. And I would encourage anybody listening to do this. I mean, I just read today what the central banks in the world bought 59 metric tons of gold just last month. Okay. So if these other central bankers around the world are taking their dollar reserves, which is what they're doing from foreign trade, and buying gold with it, you, the individual out there, might want to follow them. You've got dollar reserves. It's your checking account, your savings account, whatever. Take 2,000 of your dollars of your reserves and buy yourself a 1 ounce gold eagle or whatever from BullionMax and take delivery and hold it in your hand. And the first thing you'll notice is that it's heavy. It's a lot heavier than you'd expect because gold is really dense metal. And you're like, just the weight itself in such a small object, you're like, well, there's something substantial about this. This is cool. And then I started staring at it and it dawns on me, like every gold ounce that's ever been mined is pretty much still in existence. It doesn't get used up, gets recycled. I'm sure some gets lost. It's the bottom of the sea and stuff like that. But pretty much every ounce of gold that's ever been mined is still around. It's been recast and repoured and all these different things. So I'm staring at this ounce of gold thinking, well, heck, this could have been gold that was around at the time of Christ.
Could have been.
Who knows where this gold has been? And now I own it. And and I'm hooked. I mean, right then. And I'm diversified out of dollars, and all the other stuff we talk about financial protection, insurance against the madness of the central bankers and the dollar devaluation, all that. I mean, all that stuff is wonderful and great. But what a great investment. And you just know, rather than your statement that you get from Schwab or something, and everything else is just zeros and ones. And you hold and same thing goes for silver, but the gold is just always more spectacular because it's so much power in one little thing. So anyway, that's just my personal story. In terms of, look, I've been following this stuff for 12 years. I mentioned the racketeering trial of the JP Morgan guys and the control that these big banks have over the pricing process through delivery of metal in London and the trading of paper in New York and all that kind of stuff. If I'm right about that, then that creates a tremendous opportunity to buy something that's undervalued, a market inefficiency, something that is way, the price that you can buy it at is not truly reflective of the physical quantity that's available in the world. It's reflective of the amount of derivatives, maybe, and futures contracts that are available. But the actual physical metal that allegedly backs those contracts is far less, I think, than people think, or at least the amount that has clean provenance that you can actually own in your own two hands. So I think there's a great opportunity. Silver below 20 or at 20 is just, look, I just said the same thing 10 years ago. So don't make it sound like, I don't want to make it sound like I'm some kind of genius, that I made all this money in the last year owning physical metal. What I'm waiting for is the moment when, we revert back to some type of physical pricing structure and a revelation that the price of a physical ounce is completely different than the price of a paper ounce.
I'm going to ask you a very personal question, Craig.
Okay.
In your own portfolio, do you have money in stocks and bonds and things like that, or are you all metal?
My wife and I have separate investment accounts, which is probably good. Because
one of you will save the other.
Yeah. It's almost like we have blind trusts. I don't even really know what she does, and she as sure as heck doesn't want to know what I do. But all of mine I shouldn't say all, save my 1.8 Bitcoin that I own. All of my investments are physical metal and mining shares.
I've got some uranium shares too that I own just as a diversification because I think that story is fantastic long term, but nobody cares about long term anymore. Long term is like by the end of the week.
If I can't flip it, I don't want it.
Right. Yeah. Like I mentioned my stockbroker days, if I could make somebody 15% in a year with their dividends, I mean, I was a hero 30 years ago.
Sure.
Now, if you don't make 15% by Tuesday, you're a chump.
Yep.
So my uranium stuff, given the energy situation in Europe and green and all that other uranium stuff, I think is long-term fantastic. But all the rest of my stuff is some mining shares in my rollover IRA, and then I got physical metal, and I've got it all over the place.
Got it. So precious metals, silver and gold, gold in particular, has been bandied about as a hedge against inflation, and those are quotes. Those are quotes.
I use those
quotes. Yes, right. What does that mean today? It's different than it was 20 years ago.
Right, and this gets back to market structure, Mark. The trading of the derivatives and how almost all trading, equity trading, bond market trading, so much of it is done by computer now, right? The high frequency trading computers. I think I've seen numbers like NASDAQ trading is 85% high frequency trading computers at this point. You see these huge, massive daily volumes. That's not just some guys, sitting in their pajamas trading, shares of Twitter and Facebook and, Google and stuff like that. It's these computers nicking each other for fractions of a penny back and forth and back and forth and back and forth. Well, anyway, the same thing's true in all markets now. So when that becomes the case, if everything's done by computer, and with most of those algorithms being built to trade off of cues that the algorithms take from other markets, and when those cues are all pretty much the same markets, you kind of end up with one universal chart, that they all go up and they all kind of start to look the same, in some regards. And so in terms of precious metals, the trading of the futures contracts is based off of, is the dollar up or down on a daily basis? Is the bond market, are nominal interest rates up or down on a daily basis? So when we used to talk about gold as an inflation hedge, and there were studies done, I remember some studies from 10 years ago that said, it's not really directly tied to inflation. And this has been exacerbated in the 10 years since. What the futures contracts really trade off of, and the buying and selling done by these machines, are moves in real interest rates, which is the rate of inflation versus what the nominal interest rates are. But then it's even more nuanced than that. It's not inflation's at 9% and the 10-year notes at 2 or 3%. And so the real rate is -6. That's how you and I would do it. What they actually base it off of is what's called the 10-year break-even rate, which is an inflation expectation, which is another thing that's controlled by computer. And so if the 10-year break-even is, say, 3%, or actually right now it's less than 3%, meaning that the inflation expectation market, if you can believe there is one, there is, the inflation expectation market is trading at 2.8% 10-year inflation expectation, but the 10-year note's trading at 3%. Well, then actually 10-year inflation expectations are positive, or their 10-year real interest rates are positive 0.2%.
I understood last week, I think it was last week, that they said inflation is over 10% right now.
Right. It's 9, right?
It doesn't.
Inflation is, but that's not how the computers that buy and sell the futures contracts, which determine price, the computers are programmed to trade off of the expectations, not the nominal. Inflation's 9, interest rates are 3, so that's -6. So what the computers buy and sell off of is the expectation of 2.8 versus a 10-year note at 2.8, and therefore 0% real interest rates. It's crazy. It's stupid. It makes no sense.
We're being controlled. We're actually being controlled. I'm sorry, Craig.
No, go ahead.
We're being controlled by AI. I mean, artificial intelligence.
For now, well, I wouldn't say that, Mark, because for now it's still human beings that program the computers, right? That write the algorithms,
right?
But that's So now I'll just bring all this way back, and in our time remaining here, we talk about being honest with ourselves. You and I know what the actual real interest rate is. It's at 3% nominal return versus 9% inflation. I'm guaranteeing myself -6% this year. How much do I have to make in a real terms over the next 9 years just to get back to even, right?
Right.
Well, we can do that math, but that's not the machines that buy and sell the contracts. That they're not programmed to think that way. They just see the break-even rate, the move in the bond market. On a daily basis. They buy or sell the gold futures contracts based upon what that rate is. When gold was at $2,100 back in March, that real rate, as determined by that spread, the break-even rate and the nominal rate, was -1%, and that's what got us to $2,100 gold in March of this year and in August of 2020. So if we're going to get back there, if the machines are going to do that, we've got to get back to that level again, which means nominal rates have to come down, which they are. 10-year notes falling from 3.5 to 2.5 as we speak. But we need inflation expectations to remain sticky and actually go up. So I'm sorry, I don't mean to dilute the conversation with all this stuff, but that's really why. So when people say, I give up on gold, it's not inflation hedge anymore. No, man, that's not. You're kind of apples and oranging it here. You got to remember what determines price, the trading of these futures contracts. You got to determine what are the inputs. You got to remember what are the inputs that cause the buying and selling of those things. And then you can get a picture as to why gold is where it is in this current pricing scheme.
I think with everything being adjusted for inflation, now I'm 57. I think adjusted for inflation, I'm not quite 50.
No, you need a good hedonic adjustment there, Sean.
Man, you can say that anything is adjusted for inflation, and then just tell whatever story you want from there. And here's why I say that.
Right.
And the rest is swag.
Like in the way they do the CPI, that's all part of why the CPI is understated. What they call hedonic adjustments. Oh, sure. Your computer is, $1,000 and it's more expensive than it was, 5 years ago or whatever. I'm just using an example, but it does so much more. So actually it's cheaper. So I think the three of us, since we're so much wiser and experienced than we were a decade ago, are actually 10 years younger, not 10 years older. Is that?
Oh, I like that one. Yeah, that one. Does that mean my hair goes back to another color?
Yes.
Now you can do that without this kind of help.
Just keep telling me about that, Mark.
Yeah, I've been there, done that.
Make it whatever you like, my friend.
Yes. Hey, listen, Craig.
I've chosen not to make it at all.
That's easier. I would do that, but I have a feeling there's all kinds of interesting things up here on my.
Okay.
Anyway.
Yes.
Craig, we always appreciate your point of view and your wisdom on precious metals. We encourage people to check out Craig's website. We've had it up throughout our program, and look forward to another conversation soon. Will you come back?
Absolutely, and thank you guys. I really appreciate all that you do, and I don't just say that just to say it. I mean, I've only got a handful of companies that I allow or have in as advertisers on TF Metals Report with little banner ads down the side and all that kind of stuff. And it's got to be somebody I trust, somebody that does great service and actually is human beings that you can talk to, that sort of thing. And so I very much appreciate you guys being a sponsor and advertiser TFMR too. So we'll continue to work together.
Great. Well, we appreciate you. We really do. As we wrap up, Sean, somebody is interested in investing in gold and silver. How do they do it with BullionMax?
First step is to get educated. Let's find out what you know. Let's find out what you don't know, and let's put you in a position to feel good about what you're buying because you know why you're buying what you're buying. Don't buy it because I say so. Don't buy it because anybody else says so. Buy it based on what you've learned and what's going to help you meet your goals, because you're going to feel a whole lot better about what you buy when you're truly the decision maker once you become the educated. And I love that process. We love newbies. When people say, I don't know anything about this, where do I begin? It's like, how much time do you have? Do you want to start now or do you want to set an appointment? Either way. Our goal is to help get people educated so they know what is a premium? What is spot? What do buybacks look like? How long should I hold on to this? All of those things are important things to discuss before you buy your first item. And so we want to make sure that we're taking the time with people to get them up to speed and making those types of decisions comfortably.
Got it. Well, thank you, Sean, and as always, and thank you, Craig, for joining us here on the BullionMax podcast. And we look forward, as I said, to having you back very soon. I'm Mark Allen for Sean Reynolds. We'll see you next time. Bye-bye for now. Don't miss an episode of BullionMax. Subscribe to us right now.